So welcome to this class on financial risk management. As I've already told you, my name is Gregor Weiss. The first slide is about the outline of this course. I want to give you an introduction to risk management from a financial viewpoint. It's not going to be too quantitative, but it's not going to be too qualitative as well. It's mainly on financial risk management. And as it happens every year, when I explain to you what financial risk management is about, a number of students will leave the room immediately and leave the classroom because there's often a slight misunderstanding about what financial risk management is in contrast to risk management. Risk management sometimes has a little technical touch to it. It's concerned with the risk management in power plants, for example. And here we mainly deal with the financial aspects of risk management, but you'll see this in a bit. Now, what will we be looking at in this course? We'll start with some stuff on the organization of this course, but later on we'll start with the necessity of managing financial risk. Why do we need risk management? I will explain to you that in financial theory, you start in a capital market that is perfect. There are no taxes, a frictionless market in which you have no transaction costs. And in such a perfect capital market, one would need no risk management at all, just as, for example, a capital structure doesn't matter for the value of the firm. But we start with this theoretical assumption that financial risk management is not necessary. But in reality, as soon as capital and financial markets tend to become imperfect, as soon as there are frictions, for example, taxes, transaction costs, it makes sense for a company to do risk management. And then it should be interesting to us in research and in teaching. I'll talk about the types of risk a company faces. And if you think about the financial risk a company might face, you will immediately think of market risk. Market prices change, and if market prices change adversely, a company will suffer. For example, if you take any company on this high street here, there might be companies that deal, for example, in energy, that are banks, insurance companies, and as soon as companies need a certain resource, let it be steel, let it be agricultural products or capital, and the price for these resources change, the company might lose money. And that's what we want to prevent in risk management. We want to prevent financial losses, and we want to make sure that the profits of the company are smooth over time and shareholder value is maximized. So this might happen. If you take a bank, and actually any industrial company, it might happen that the company still expects a customer to pay back a certain amount of money. A bank expects its customers to pay back on their loans. But what happens if these customers default? The company will be left standing there with a loss because the customer has defaulted. And in this case, this amounts to credit risk and default risk. And many companies face default risk, and they have to manage default risk. And last but not least, in many cases, it might just happen that, for example, in this room, we also have a third type of risk that is called operational risk. If, for example, this projector would fall onto your head, the university would be liable and could be sued. So this is a risk for the university. If suddenly we have an energy blackout, we would have to stop the lecture. No great loss, you might say, but still it's a nuisance. And this is operational risk. The risk that your operations are interrupted. And if you think of large companies, especially IT risk pose a severe threat to the operations of a company. Imagine, for example, the Amazon servers would go down. they would lose millions and even billions on that day if they don't get their servers up and running again in a short period of time. So this is operational risk, and you can see the significant differences between market risk, credit risk, and operational risk, but they all lead to financial losses to the company, and that's where we need financial risk management. We want to measure and we want to manage these risks. And then it's quite clear, you have to identify the risk sources. You need to know where your company is exposed to risk. You need to measure these risks. And if you have measured the risk, you need to make sure that your measurement and your models are on top of things. You need to backtest and to stress test these models. And this is just making sure that you have the best models and adequate models that can measure and manage and hedge your risks. A course on risk management would be incomplete if we weren't to talk about financial derivatives. Because it's one thing to know where your risks lie and what risk you are exposed to as a company, but it's another thing to know what to do with these risks. And in many cases, if you know that you are exposed to a certain amount of financial risk and you want to do something about it, one possible solution would be don't enter a contract and don't do the business you intended to do. But then again, just doing nothing instead of doing business is not the solution. The solution is to do the business you had originally intended to, and then to hedge the risk, to reduce your risk exposure by entering a contract, usually a financial derivative, that is short, that goes in the opposite direction of your initial contract. Simple example, if you buy a stock, you are exposed to the risk that the price of the stock will go down. So what do? You buy an option contract that will go up in price if the stock value goes down. So it's a position that is opposite to the underlying, and you suddenly have hedged your risk by building a second financial position that has an opposite evolution in value than your first one. So we start with financial derivatives. We need to know what financial derivatives are. And then we'll look at some selected hedging strategies, how we can construct these hedging positions. Okay. So this is the outline, and let's start with the basic course organization. You have probably seen by now that this is an elective course in the BSc Economics and Business. You can choose it in any other subject you might be taking, like math, computer science, physics even. You will get 5 ECTS credit points. The assessment is done based on a written exam of 60 minutes. If you go to the course website, you will find some former exams from previous semesters. And it's the 2-hour lecture here and a 1-hour online video tutorial you can find on YouTube. There are a bunch of practice questions, and you can practice for the exam by watching these videos, and you also have the slides on the website. Okay. You can go to my website, which is quite simple. You go to www.gregorweiss.com, and then you go to teaching. In there you will now find the course page. There you can download the first set of slides, the slides for the tutorial, and also the script from last year, which hasn't changed and is in German. So if you are unfamiliar with, and if you feel uneasy about the English, you can use the German script that is still uploaded and available on the website. Okay. If you want to contact me, write me an email, weiss@wifa.uni-leipzig.de, and you can tell me your problem, and I will try to get back to you in let's say not maybe one day, but maybe a couple of days. Okay. Now, as you have already seen, I'm recording the lectures here, and you can go to YouTube, and by pressing this button, you can subscribe to the YouTube channel. The videos will be uploaded publicly, so you can also search for them. But I would recommend for you to subscribe to the channel, and then you can see all, and you will get notifications as soon as I'm uploading the video. The problem with these videos is that I cannot guarantee that I will be able to record and produce and upload videos for all classes. Why? Because sometimes the files are corrupt. These files are like 2-3 gigabytes large, and it sometimes happens that while saving the file there is a slight error, and then I cannot produce the video. That has happened at least once every semester now across all lectures and all courses I give. So it might happen that there is an erroneous video, and then I cannot upload this one. Okay. And the production of these videos takes such a long time, usually 1 or 2 days, that I will not be able to upload all videos in real time shortly after I've given the class here. So it's convenient for you, but don't expect 100% on-time delivery of all videos. I mean, this is an additional feature you have here. So if you just go and click on this link, you will get to the YouTube channel. Okay. Now, what textbooks can I recommend? First of all, you don't need textbooks. Everything you will need for the exam is on these slides. So there will be nothing more and nothing less than is on the slides in the exam. But if you want to read this, to read a little bit more about financial risk management, I can recommend a couple of textbooks. The first one is, coincidentally, is also my textbook. It's in German, Unternehmerische Finanzierungspolitik. There is one section on risk management that actually this lecture is based upon. So if you want to read it in still my words, but in a slightly more elaborate way, you can take the textbook and you can read it in here. So this is one textbook. The second one is risk management, and this one is available in both German and English. It's by Hull from the University of Toronto, a famous classic textbook on risk management. And this one's pretty good. I would recommend reading it in English, in the original. There is a third textbook here, and this might be of more interest to the math student. This one you probably will not remember, but the second author, Rüdiger Frey, was actually a professor of optimization and financial mathematics here at Leipzig University. He moved to Vienna. But Quantitative Risk Management Concept, Techniques and Tools is a fabulous book, but I would say I'm only using 1 or 2% in this lecture here, because this one is written by mathematicians, for mathematicians, or at least statisticians. And this is hardcore if you have never heard a lecture on mathematics or statistics and probability theory. So I would not recommend it to the general audience, but for those interested in the quantitative side of risk management, this is a good start. And one has to admit that this is not, although it's written for mathematicians, it's not the usual math textbook. It's still very applied. Okay. At some points, I mean, I'm still the chair in banking here at the faculty. Many applications and many examples will be taken from the field of banking. So it makes sense every now and then to look at the regulation of banks and to look at what banks are doing, because banks and insurance companies usually are the companies that go first in risk management, that develop these methods, and later on industrial firms adopt the things banks have already been doing for 10 or 20 years. So in many cases, the examples are taken from banking. And in this textbook on banking, Bankbetriebslehre, Hartmann, Wendel, Pfingsten, Weber, this is the standard German textbook on banking. There is a large part in it also that is devoted purely to risk management. Okay. Some additional textbooks. Again, Bankbetriebslehre, this is very low-profile applied book on banking. There is also a small part on risk management, but this, if you've already seen all the other textbooks, this would be overkill, but just to be complete. Options, futures, and other derivatives, again by Hull. This is the second standard textbook on risk management and financial derivatives. You can see that there are some parts in the options book by Hull that is also included in the risk management book by Hull, and they overlap to a certain extent. But this one is, I would say, the most famous textbook in this whole area of finance. So when it comes to risk management and derivatives, you will always take the Hull. Okay, good. So these are some ideas for textbooks. Again, if you don't need them, you can just look them up if you want to read a little bit more about a certain topic. What I want to do, I've already talked about this to some extent. I want to introduce you to this field of risk management, which has become more and more important even for many industrial firms. Energy companies, even car manufacturers, small and medium-sized enterprises now see the necessity or are forced to by lawmakers to establish a risk management function. And I want to show you how risk management works, usually with a large focus on financial institutions, especially banks, because as I've said before, banks are usually the companies with the most elaborate risk management there is. So you have banks at the top, insurance companies, then maybe energy companies, and after that industrial firms, and then it decreases with the size. I want to show and present to you the different types of risks. Again, one would immediately think of credit risk. Everyone knows credit risk. Even you might have a credit risk if you have ever loaned a certain amount of money to a fellow student, but who would think about this projector? And I think one of the best examples for this definitely unknown risk, previously unknown risk, was the case of the Fukushima nuclear plant in Japan. Japan has seen earthquakes for thousands of years. It has become used to earthquakes. Buildings are built so that they are built to withstand earthquakes. They knew about tsunamis, but they didn't think about the tsunami wave hitting the nuclear power plant on the shore, and then, well, you have a disaster. So this is why risk identification is also very important. It's not just about market risk, price risk, and credit risk, but sometimes about the possibility that you might not be aware of a certain risk. And then the rest of the class is all about how to manage and how to measure these financial risks. And sometimes we will be looking at the regulation of banks and insurance companies, just to show you how regulators and lawmakers demand a certain amount of risk management in these types of institutions. And it's not just out of economic rationale, but it's actually in the law. Okay. Yeah, you have a question.
So I did not receive the password for the slides via mail.
Yes, the slides are password protected. That's good. It's sector pound 7G with a K in there, a capital S, a capital G at the end. If you don't remember this strange password, it's from The Simpsons. There's a scene in The Simpsons where Homer tries to escape the power plant and he gets a note. If it's the plant you want to flee, go to sector 7G. Yeah.
Do Germans have to write the exam in English?
Yes. Yes. Yeah. Any further questions? For the exchange students, you can choose between the exam, an Erasmus paper, or an oral exam, if you want to take an oral exam. Might be better or worse, I don't know. Okay, yeah?
Does it mean that we have to answer the questions in English also? Or is there any possibility to choose between answering in German or English?
I think you can answer in German or English, but the questions will only be posed in English. Yeah. Last year in banking, we had both German and English questions. They were the same, but we translated them from English to German. I would say that this year we start just putting up English questions in the exam. Okay. Any further questions? Okay, so let's start with a small example. Actually, this example is almost 10 years old. So it's not quite recent. Actually, I think there are still news about this former CEO around, and the lawsuits haven't been settled yet, and the criminal cases. This is an example from Focus. Focus Online, to be precise. Focus is a large German magazine, and it's the news bit is in German, so I'll translate it for you. The public accountants criticize risk management at HSH Nordbank. HSH Nordbank, or HSH Nordbank, is the state-owned bank of the federal states of Hamburg and Schleswig-Holstein. It's quite different in the German banking sector. We have several state-owned banks. For example, HSH Nordbank. There is one large state-owned bank in Bavaria and one in Baden-Württemberg. LBBW is, for example, one large state-owned bank. And this one still exists. And during the financial crisis, most of these state-owned banks got into serious trouble because usually they had very boring and conservative business models. They were state banks that gave out loans to small and medium businesses in this particular state, and they were meant to spur economic growth in this federal state, for example, Saxony. And then at some point they realized they were not making high enough profits, and they started to engage in risky business. And those were the banks that were hit hardest during the financial crisis. And this CEO, you can see a small picture of him. He became quite famous in Germany at that time. His name is Jens Dirk Nonnenmacher. He has a PhD, so he was Dr. Jens Dirk Nonnenmacher, and he has a famous nickname. In the bank, he was known as Dr. No. Like the evil from the very first James Bond movie. He got canned during the financial crisis. He was blamed for that, and he was tried in court for negligence and for entering into risky contracts. He was not allowed to do so, presumably. And the public accountants that were hired by the states of Hamburg and Schleswig-Holstein, they investigated the activities of the bank, and they criticized heavily the risk management at HSH Nordbank. So this is still going on. The states of Hamburg and Schleswig-Holstein are still trying to sell off the remnants of this bank because they have lost a couple of billion euros due to the activities back then from HSH Nordbank. And what did they do? During the financial crisis, they suffered severe losses due to write-downs. HSH Nordbank was hit particularly hard and had to be saved from insolvency with federal liquidity guarantees. And in 2009, the auditors and public accountants identified a number of violations of the bank's minimum risk management requirements. They said they didn't even fulfill the minimum standards for risk management in a bank. And at some point, it was quite... Actually, this one wasn't the worst. Hypo Real Estate was even worse, and KfW, another German state bank, really hit the spot. They wired a couple of million euros to a company that was already that had already defaulted. So no one in the bank realized they were about to send a couple of million euros to a bank that was already in default, and they never saw a euro from that. So that was how bad risk management at some places was back then. And HSH Nordbank was probably one of the worst examples. And what they had was they had insufficient monitoring systems. They were not able to correctly value their financial assets. They had, like any other bank, they had bought securitized mortgage loans. They had invested in the US housing market, but they were not able to find the correct prices and the correct value of these assets. So their valuation methods were not correct. And as a result, they lost almost 100 million euros due to various weaknesses in the risk management process. And this is not just happening by chance, that when prices went down they lost a couple of billion euros, but these were just another 100 million euros they could have saved if their processes had been right and had been better. Okay. HSH Nordbank. So let's start with a very basic question. What do you think risk management is about? And what do you think is risk? And I have to admit that this question, what is risk, is actually quite philosophical. Let's start with risk. How would you define risk? Yeah?
The possibility to lose money.
The possibility of a financial loss. Okay, any other idea? Yeah?
For me, it's the opposite of security.
Yeah, quite interesting. We'll be working mostly with the first definition, the probability of a financial loss. So you have probability in there, so it's uncertain. The definition you have given is actually the one from risk theory. So if you know, for example, if you roll a die, and if you know what will happen, this is certainty, there's no risk. But in the case of a die, or if you throw two dice, this is classical risk from risk theory. Why? Because you know that it will be either 1, 2, 3, 4, 5, or 6, but you just don't know which one. And you know the probabilities. If you know anything at all, it's uncertainty. But in case you at least know what could happen and what probabilities there are, it's risk. Yeah? Actually, we will see a counterexample in which even financial profits could also be interpreted as risk. No? But this is risk. Let's start with the idea, the probability of financial losses. What then is risk management? And those don't say, well, it's the process of managing risk. But what does management mean? And remember what you might have learned from other lectures when it comes to supply chain management, marketing management, human resource management. What is management? Yeah.
And everything that deals with risks that can encounter your business or the environment of your business, and how you handle it.
Everything that is connected to how you handle it. Okay. Usually it's a circle, and you try to assess the situation, get the information, try to think of possibilities how to act. Then you have to decide, and after taking a decision, you have to reevaluate your decision and do it again or change your behavior. So this is usually management. For example, take marketing management. You would see the necessity to do marketing, to do an ad, to buy an ad in a newspaper. Then you have to assess the situation. You need the information. Which newspapers are there? What are the costs? Then you have to decide where to place your advertising. And then afterwards, you have to evaluate, was the ad successful? Did you generate higher profits? Did you generate higher sales? And then you reevaluate your decision and either do it again or choose a different newspaper. So that would be marketing management. And here in risk management, it's almost the same. You have to think of what risks are there, risk identification. You have to identify and measure the risks. Then you have to think of possibilities how to hedge, how to reduce, how to avoid, and how to deal with these risks. And after dealing with these risks, you have to assess and reevaluate your decisions. And if you think you've done the best thing possible, don't change the thing. Otherwise, you have to choose a different strategy how to deal with the risk. Okay. So let's try to give a definition of risk. First of all, let's start with risk. You were actually quite on spot here. Financial losses are usually what we understand by risk. Could be the uncertainty about the likelihood of possible environmental conditions. As a result, uncertainty of achieving specific business goals. So this is a more general definition. It could also be a deviation of a parameter from its expected target value, but in this class, usually it's the random negative deviation of financial variables from previously defined reference values of asset positions. What does it mean? It could also be a random negative deviation from a random starting point. Say, for example, you were expecting a profit of 50, but you now only make 30 euros in profit. This is still a profit, but it's also a negative deviation from what you would have expected and what you were expecting. So in this case, this is a risk to you. Although you're not losing money, you're not making enough money as you were expecting. So this is this negative deviation. It's not so obvious that we would always look at negative deviations, because there are a couple of counterexamples in which you can see that one should also look at positive deviations. Do you have an idea why such a positive deviation could also be a risk to your company? Or why it could indicate a risk? Yeah?
Yeah, higher profits usually mean you have to take higher risks to achieve it.
Now, if you were expecting 50 and you actually made 1,000 euros profit, there are only two possibilities why you could have achieved this. First one, pure luck, not very likely. The second explanation is you took high risk. And if you were expecting to earn 50 and suddenly make 1,000, this is a high risk strategy that could have also gone to maybe minus 1,000. Again, think of a casino. If you go to a roulette table and you start with 50 euros, you don't expect to win 1,000 on the next game, only in case you go a high risk strategy. If you put your money on red or black, you would expect a low payout. Yeah? So higher profits usually mean higher risk. Okay. So what are the basic characteristics of risk? First of all, we need randomness. As soon as a payment is certain, it's no longer a risk. If, for example, in a contract you are contractually obliged to pay out a certain amount of money, it's no longer a risk, and risk management is not concerned about this. It has to be random. This is why we need methods from statistics and mathematics. Usually it's a negative deviation. It might also be that a positive deviation poses also a threat, but usually we only look at negative deviations. It should be financial. In this class we only consider financial risks. So what do we not look at? We do not look at reputation risk. We do not look at the risk that a company ruins its own reputation, its standing with customers, etc. So if you thought that risk management was just about minimizing risk exposure in a scandal, this is not financial risk management. You might deal with this in different types of classes, but here we only are concerned about financial losses. And ideally it should be measurable. So we have an idea of what risk exposure we actually have. A prime example of a risk that is not measurable is, I've already talked about this, Fukushima nuclear power plant. Yeah? You cannot put a number, you cannot put a dollar number on the risk exposure and the potential loss of such a disaster. If I told you I have an investment of 100 euros in Daimler stocks, you know my maximum risk exposure is 100 euros or $100. If I buy an asset that is worth 100 euros, I can only lose as much. But with different types of risks, there is an unlimited risk exposure, and it could also be that it's not measurable because no one knows how much, for example, a nuclear meltdown would cost. Yeah?
But is it measurable when I have a plane and this plane is flying into the World Trade Center? So
No.
This is measurable.
That's not measurable.
But
You can-
after, it is measurable. Small fact.
It might be measurable afterwards,
Yeah.
but then again, I would say, even if it's measurable, it's of no use to you. Knowing, for example, that Fukushima in the end will cost, let's say, $120, $150 billion, of what use is it to you? You will not be able to insure this. You will not get a $150 billion insurance, and you cannot hedge it. You simply know that, and you know that beforehand, that all nuclear power plants should now be protected against this sort of risk. Otherwise, it will ruin the company. Yeah? So this is a life-threatening risk for your company, but the measurement of risk is of no practical use. Okay. But sometimes this is sufficient to know that actually this is a severe risk with a very high risk exposure. Usually when it comes to operational risk, like for example a projector falling down, blackout, IT server going down, etc., or nuclear power plant, natural disaster. In these cases it suffices to know that it's a high risk exposure and a very severe risk to know how to deal with this. For example, I know of, has any one of you ever been to Münster, the German city of Münster? At least one. In Münster there is an insurance company, not a very large one, but there's a mid-sized insurance company. And I know for a fact that they have, at one point, they identified a special type of operational risk. They are, I think, 2-3 kilometers away. The headquarters is 2-3 kilometers away from a chemical plant, BASF. They have a large chemical plant in Münster. I think they produce colors and stuff like that. And they have an emergency plan for the case and for the disaster that would ensue in case the chemical plant blew up. Because then there might be a poisonous cloud moving along the street right to the headquarters of this insurance company, and they have an emergency evacuation plan in place, but also they have an emergency plan to keep their operations running in case they have to evacuate all their staff to other offices they need to rent, and a large part of their workforce has to work from home because they need to keep their operations running. They're an insurance company. So you don't need to have to measure this. You don't need to be able to measure this risk and to put a price tag on it, but you simply need to know that this is a threat that could interrupt the whole operations of the company. So you need to make the necessary precautions. Okay. Now, 2 examples to highlight the fact that not just negative deviations pose a threat, but also positive ones. The first one is the downfall of Baringsbank plc. You probably don't remember this, weren't born back then, I'm afraid. This is a very famous case. Baringsbank was a large UK-based bank that in 1995, more or less overnight, went bankrupt. What happened? There was a famous trader working in the Singapore office for Baringsbank, Nick Leeson, not Liam Neeson. He would have found a different solution, or blown up the company otherwise, but Nick Leeson. Nick Leeson was a derivatives trader with Baringsbank, and he did the, I would say, classical thing a rogue trader does. He kept 2 accounts, one for the profits and one for the losses. The account for the losses he hid from his superiors, and he only showed the profit account to his superiors. Result was he was promoted and promoted and promoted unless he was, I think, the chief derivatives trader in Singapore, and he did this for quite a while. Why? Because seemingly he was such a good trader. He was so successful and he earned so high profits for the bank that his superiors just kept on promoting him. At some point, something happened. The bank went bankrupt overnight. Why? In 1995, Asian markets were hit by the Great Hanshin earthquake that took place in Kobe, in Japan. You probably haven't seen this. It was a large earthquake. I think about 6,000 people died back then, and it is famous for the horrible pictures on the TV, because there were some highways that rolled over, that collapsed, and buildings collapsed as well. And fires broke out, and this was one of the most horrific events in recent Japanese history. Asian markets were immediately hit, and when Asian markets went down, Nick Leeson was no longer able to hide his losses. So what did he do? He packed his bag and fled the country, and he was arrested at Frankfurt Airport by German police and then extradited to the UK. And he got a long jail sentence in the UK, and is now, I think he has been released. He also suffered from cancer. One person, one rogue trader, a $1.4 billion loss, and a whole company thrown into bankruptcy overnight. And how was he able to do this? He was able to go into high-risk positions with no one noticing this, and he only reported high profits. And this should have gotten superiors suspicious. Actually, it's also a very good example for the interplay of many different types of risk. You have a natural disaster, you have a rogue trader, you have risk management processes that are insufficient. And if everything comes together, the natural disaster hits, the rogue trader is not controlled because processes are insufficient, a company might go bankrupt overnight. The second case, also a very, very famous one, and you might know of this case. It's the case of Bernie Madoff in the financial crisis. Bernie Madoff operated the by far largest Ponzi scheme in the US. Who does not know what a Ponzi scheme is? In German, it's Schneeballsystem. What is a Ponzi scheme? It's named after the first person that did this in the US, Ponzi. So there's no special meaning to it, it's just the name of the first operator. What is a Ponzi scheme? Let's start a Ponzi scheme in this class. Yeah? I'm now offering you a fund, an investment fund, and you can give me your money and I will invest this money and I will give you a certain return. I'm offering 12% return, risk-free. Now, the four of you will give me 400, let's say, in total 400 euros. I have 400 euros now. And I will tell you 12% return. Okay. So after a year, I will ask the six of you to give me 600 euros in total. And I'm telling you, I'm paying out actually 15% return. And I will use your money to pay out the 15% to my first set of investors, but I'm not doing anything with the money. I'm just keeping a certain part of the money for myself. I'm paying out my previous investors with the money I've taken from you as new investors. Now we have 6 persons who have invested in my fund. I have a great lifestyle. I can spend a lot of money, and the 2 of you are all defrauded. You will at some point realize that actually your money's gone. And I did this with 1,000 euros in this example. He did this with 65 billion US dollars. And many companies, many pension funds in the US had actually invested in Bernie Madoff's funds, and they all lost their money. Yeah? It's a story you wouldn't believe if it weren't real. 65 billion US dollars, and he took the funds, he guaranteed and promised constant high returns, even with a low risk, presumably low risk strategy. And the question then is, why didn't anyone get suspicious? Well, there was people who got suspicious. One whistleblower later said, the biggest tip-off of a fraud was that Madoff reported his fund was down only 3 months out of 87, whereas the S&P 500, the standard index for the US stock market, was down 28 months. So he was always reporting profits and profits and profits and profits, even when the market overall went down. And he was able to do so just until the financial crisis, when the markets went down so severely, everyone wanted out. Everyone wanted money back from the fund, and he was not able to pay out his clients. So again, if you see that something is too good to be true, it might just be that. It might be too good to be true. In this case, one should get suspicious, and this always happens when people only report profits. If they report high profits at a low risk, this is usually never the case. The same is also true for retail clients in Germany in the financial crisis. You might remember that in the financial crisis, there was a famous bank from Iceland, I think Iceland, that became infamous in German, Kaupthing Bank. Kaupthing Bank sold investment products at with a high return to German retail customers, somehow claiming that these investment products were risk-free and that they fell under German deposit insurance. They didn't. But then one would immediately ask, why did you think something was risk-free if they promised you 6%? During a time, everything else that was risk-free only paid out 3%. So why did you believe this? Well, sometimes people just get greedy. Okay. So how should we measure risk? If we know that one should be suspicious in case profits are too high, are too constant, or if the risk-return profile is just too good to be true. One first thing you can do is you can get the prices. You go to, for example, this is taken from Thomson Reuters Financial Data Stream. You can go to Data Stream and you can download such an info chart on a stock. This is actually not a stock, it's the S&P 500. And you can see that between 95 and 2015, the S&P 500 had a general upward trend, but it also had its ups and downs. For example, here you can see this is the financial crisis, this was the dot-com crisis, and the 2001 9/11 attacks. But then it also goes up. So how should we measure risk? What can we do? We can look at changes in the price, plus 2.79%. Over the whole year it was up 12%. So you can look at changes. What else? What else can we do? If I were to ask you, what is the risk of the S&P 500 over these 20 years, what would you say? No idea? Yeah?
So what we can do, we can take as stop losses so that we don't fall.
Yeah, but we want to know what risk the S&P 500 poses to us. How can we measure risk? The first intuitive idea is to take the standard deviation of the changes. First of all, if this is the price and it goes up and then it goes down, we can transform the prices into returns, because this is what we are usually interested in. We don't want to know whether our portfolio is worth 5,000 or 50,000. It depends on our initial investment, and the return is exactly giving us this. So plus 3%, minus 2%. We are interested in the returns of our investments, on our investment. Now, if we take the returns, it is interesting to see how do the prices and the returns change. Do they go up? Do they stay the same? Do they go up and down and up and down again? And we can measure this type of risk by taking the standard deviation of the prices or of the returns. So this is actually what the standard deviation looks like for the S&P 500. You can see exactly where the financial crisis hit. This is this point, and this is here, and this is the dot-com bubble and the 9/11 attacks. So you can take the volatility, the standard deviation of the prices and the returns. Does anyone know what is shown here? It's not exactly the volatility, but what is it? Well, it's right here. It's the VIX. It's the volatility index on the S&P 500. Does anyone know what the volatility index, the VIX, is? The S&P 500. First of all, you have to remember the following things about financial markets. You cannot simply buy the market. You cannot simply buy an index. You can only buy individual stocks and individual instruments. Now, if we were to start a stock exchange, let's assume every one of you is a company, you all issue stocks, and then we will trade around with our stocks, but then someone will think of, let's make an index. Let's take the 10 largest companies and let's make an index. Well, I can do the same. I can invent an index of companies with funny names. I will call it, this is my funny index, or something else, or just an index for companies in the meat packing industry, whatever. And you can create any index you like. And most indexes were created like this. For example, in the UK, you might know that the major stock index is the FTSE, the Financial Times index. So the FTSE 100 was invented by a newspaper. The DAX is an index by Deutsche Börse. But you cannot buy an index per se. You can only buy the stocks that are included in an index. Now, this is not very nice for an investor. If you wanted to buy an index, you would need to buy, say, 5.32% of Deutsche Bank, 5.88% of Daimler, 1.39% of Adidas, and this is quite cumbersome. You have a lot of transaction costs. You need to buy all the stocks in the right amount, and this creates a lot of transaction costs. So what do? At some points, investors and financial markets realized that there was a demand for indexes and for the opportunity to invest in an index, and then someone created a fund, an investment strategy, a financial instrument that tracks the evolution, the price evolution of, for example, the S&P 500. So now, does anyone know how these financial instruments are called? Any idea? These are exchange-traded funds, ETFs. And these are just new financially engineered instruments that pay out exactly the amount of money, for example, the S&P 500 gains or loses on one day. And this is an exchange-traded fund. So you can create a new financial instrument that tracks the price evolution of, say, the S&P 500 or the FTSE 100. And then what is the VIX? It's exactly the same with one important difference. It does not track the S&P 500, it tracks the volatility of the S&P 500. Computed and calculated in a very specific way, but this means that if you were to invest in the VIX and the volatility of the S&P 500 increases, you will earn money, and if the volatility decreases, you will lose money. And this is how the VIX works. You can invest in the volatility of the S&P 500. And I could also create another financial instrument. I would say I create an exchange-traded fund that tracks the number of students in the classroom. If someone leaves, I will get €1, and if someone comes in, I will lose €1. And it will pay out the opposite to you as an investor. Same principle. Okay. So this is the VIX. This is a quite simple way to download information on the volatility of the S&P 500. You take the corresponding volatility index. This is one way to invest in volatility. Okay. So, how can we measure risk? We start with the prices. Again, the price doesn't tell us too much about the volatility, the negative deviations of what we would expect. So next possibility would be to calculate continuously compounded log returns. So this is just the logarithm of PT minus the logarithm of PT minus 1. So these are continuous log returns. This has advantages over discrete returns. A very simple advantage is that if you define your returns by this, it's a continuous random variable and it makes things easier in statistics. So these are log returns. It's okay, you have a lot of returns, you don't exactly know what to do with them. Next thing you could do is you could take absolute returns. If you take absolute returns, this looks pretty much like the volatility of the index. But just like the volatility, absolute returns do not distinguish between positive and negative returns. So it's one idea to look at this, but you don't know on which days you lost money and on which days you earned some money. So it's the same as the volatility, just like the standard deviation. You can still see the parts where you lost money and in the times in which you had trouble, but you don't know for sure. Next possibility would be to take all the extreme returns below the 5% quantile. Does everyone know what the a quantile of a distribution is? Assume we have a profit and loss distribution. We could simply call this a P&L, the profit and loss distribution. Why? Because we usually work with both profits and losses, and this is the distribution of profits and losses. What is a quantile? For example, the 5% quantile is the value x on the x-axis here, so that 5% of the probability mass are left under this distribution. So you have 5% of probability here and 95 here, and this is the 5% quantile. The 1% quantile would probably be here, and this would be the, I would say, 80% quantile. And we take the 5% quantile and we look only at those losses that are even worse than the 5% quantile, and you can see these are the extreme losses. For example, -8%, -7%, -7% here. One would think, well, -7%, -8%, that's not too much. I'm not really losing too much of my money. But please keep in mind, first of all, this is the S&P 500, so it's an average loss over all stocks, and I would assume Coca-Cola, General Electric didn't lose as much as, for example, Bank of America and Citigroup. They lost even 20-30% on their stocks. Second info here is that this is a daily return. So you can see this here. The stocks probably lost 5% today, 5% tomorrow, 10% after that. So if you sum all these losses up, you will see that the cumulative return is probably close to 40-50% in 1 or 2 weeks. Yeah? So even though 7-8% do not sound as higher losses, they actually add up to quite a lot of losses. This is the same picture, just with the 10% quantile. One would see that, okay, we now have the same extreme losses, but we also look at some losses that are not as extreme as in the first picture. We could also look at the extreme profits above the 90% quantile or the 95% quantile, and you can see during a couple of days there were daily returns of almost plus 12%. Do you have an idea what these days were actually? In many cases, these were days on which the stock just recovered. They lost 10%, next day it went up 10% again. So, okay, on average, again. This is probably the bailout announcement by the US government. Okay, so we've seen quite a bit about how to measure risk. Usually, first of all, we need prices, we need returns, then we'll look at deviations from what we would have expected. Usually we'll concentrate on financial losses, but it also makes sense to look at profits. And then it's usually based on random variables and P&L distributions. So what is risk management? Risk management is understood as the sum of all total measures that are needed for the systematic identification, measurement, management, and control of risk in the enterprise and its relevant environment. And its primary goal should be stabilization or, even better, increase of the shareholder value. The basic question you have to ask yourself is, why should we do risk management? If you do it as a risk manager, as part of the company's management team, you should only be concerned about shareholder maximization. Reputation is nice, sales are nice, profits directly relate to shareholder value, so it should always be about the maximization or at least stabilization of your shareholder value. And shareholder value is, of course, the market value of equity. Okay. Now, one could be, I have to say that, one could also think about additional goals for risk management. For example, environmental protection, customer satisfaction, consumer protection, etc., etc. But then again, everything else will always come back to shareholder value. If you pollute the environment, you will get fined. You will get fines by the government and your shareholder value will drop. If, for example, you are Volkswagen and you manipulate your emission statements, you will lose money and your shareholders will suffer from this. If you lose reputation, if you have a scandal, for example, one large German insurance company a couple of years ago, they sent half of their employees and their salesmen, they sent to Hungarian brothels. This is a reputational risk. And all these risks at some point will come back, they will backfire, and you will lose in shareholder value. So it's not an extreme capitalist way of looking at things, because in my business administration introduction, I know I usually every year I get at least one evaluation sheet that says I shouldn't preach the theology and the religion of capitalism. It's not that. It's not an extreme capitalist way, but it simply is a rational way of looking at this. Everything else should always be reflected in shareholder value. If you take, for example, Facebook now, if you sell the data of your customers, well, people will do what I did. They will delete their Facebook profile, and the company eventually will suffer, and shareholders will notice. So, at least theoretically, it makes sense to simply look at shareholder value maximization, because everything else only comes in second to shareholder value maximization, and managers should only be concerned about shareholder value. Okay. Now, risk management is not a static process. It's a continuous one. It's a very dynamic process. And you can see this from one of the next slides, where you can see the risk management process. It always goes in a circle. Let me just skip that. This is in German. Risk measurement, risk control, and hedging, risk identification, and you always need to reassess and reevaluate your decisions, because markets change, market participants act in different ways, and you always need to react to these changes. So risk management is a dynamic process. It's the first one. It is also a central management task. And risk management is one of these things you cannot delegate really, and you especially cannot outsource. You will never find a company that will outsource risk management. Why? Because it's one of the fundamental tasks of management to deal with threatening risks that could expose the company to bankruptcy. So it's vital for the survival of the company, and you cannot simply outsource it like an IT center or, for example, a call center. And as such, it usually cannot be delegated. So you cannot hire a consulting firm to do the risk management for you. You will hire consulting firms a lot to advise you on the best way to set up your risk management, but you will not delegate it. Okay. I've already talked a little bit about the risk management process, and this is it. You need to identify risks. So which risks have an impact on the company? You need to assess and measure the risk you have already identified. You need to manage the risk. How should I deal with the risk? For example, let's take two examples from operational risk. First of all, can we prevent and eliminate the risk of this projector falling down? No. Elimination and risk elimination would mean we dismantle it and we have no projector at all. So in this case, we want to take this risk, but we have to minimize it. One way would be to minimize the danger of the projector falling down. We could, for example, use a net, a safety net. Not a very good solution, I guess. We could buy insurance. There's a different, you can see the different character of the two approaches. The first one is, let's put up a net so it doesn't fall onto anyone. The second approach is, let's just hit it. Let's just let it just hit a person. We'll buy insurance, and we don't care about it. Huh? The third idea would be to put some. What else could we do? To do regular controls. Another approach. And this is how you see how you can manage the risk in a different way. In many cases, there are risks that should be eliminated. For example, the risk that a fire breaks out. A fire is always unnecessary. The risk elimination would be to dismantle the whole building, so this is not the solution, but we can put up fire detectors. We can buy fire insurance, put up fire detectors, and with financial risks it's almost similar. In some cases you don't want to take the risk. In other cases, for example, if you buy a stock, you want to take the risk because this is how you make a profit, but you want to keep risk at a certain level. So you have to minimize and you have to hedge risk. This is risk management in its original sense. Then you need to control risk. How well have risks been handled? What needs to be changed? Is risk measurement okay? Have we identified all the essential risks in our company? And then we need to communicate this and the result of our risk management to our stakeholders. In many cases, for example, with banks and insurance companies, regulators demand frequent updates on the risk management, and they will audit your risk management. So you need to tell them anyway. In other cases, for example, if you're an industrial company, it might just be that you want to tell your investors that you have a good risk management in place because this is an asset for investors. Might be that investors like this, and you have to at least tell your internal employees. You need to tell people we have a risk management in place in case something happens. For example, I should edit this out from the video, but at least I'm not aware of any emergency protocols we have in place here at the university. So if a fire alarm goes off, I'm just as clueless as you are. So this means, it seems that risk management communication is imperfect at this point. So at least I should be told what the correct protocol would be. And this is internal communication, but in some cases you also need external communication when regulators come into play. Okay. I mean, probably quite simple. We just go out and we walk into the direction of the green lights. So, risk identification. I think I've talked about this enough now. Risk identification, it's quite evident if you enter a certain financial instrument, if you buy a certain financial instrument, but in some other cases it's not as evident. For example, I would assume that some of you will not be sitting right here next week, starting next week. You have now become aware of a problem, you now know, okay, there might be a risk. Actually, you I specifically asked for a seat not next to the engine. I didn't want to sit on a window seat right next to the engine after this incident in the United States. So it's in some cases interesting to see where new risks emerge, and you need to be aware that, and you need to know that you will never know all risks in your company. Okay. Risk measurement. In many cases, you will use quantitative risk management. That is, you will try to come up with statistical models that give you an estimate of the risk exposure you have. For example, it's quite simple. If you have a $100 investment in a stock and you know the P&L distribution of the stock investment looks like this, you can simply say, okay, I'll take this. This is my maximum loss for this $100 or euros, and then you can put a price tag on the risk. In many cases, this is not possible. Again, for example, the possibility of a fire breaking out here and operations get interrupted, you might not be able to measure this with a money unit, but you can ask around and people will tell you this is a medium risk, this is a low risk, this is a severe risk. And then you can use methods from qualitative risk management to, for example, expert judgments to measure this risk. No? Quite interesting is to note that quantitative risk management is heavily based on actuarial science. Is the word actuarial clear? In German it's aktuariell, Aktuarwissenschaften, and an actuary is just a mathematician working for an insurance company, calculating premiums for an insurance company. Many things come from insurance companies because, well, if you want to define insurance business is managing risks, managing personal risks, life insurance, health insurance, property and casualty insurance. It's just risk management, really. And so many methods were developed by actuaries centuries ago that are now being used by banks and financial institutions in general and industrial firms also. Okay. The third step is risk management. How should you deal with it? There are certain strategies you can use. Risk avoidance, eliminating risk completely. It works sometimes, but sometimes you want to take a certain amount of risk. Risk reduction, for example, by hedging or diversification. Risk transfer, for example, you can transfer risk to an insurance company. The risk will stay the same, but it now lies with the insurance company, and this is quite convenient for you. And last but not least, risk mitigation. In some cases, you can mitigate risk by setting up limits. For example, in an insurance company, you have so-called underwriters, also the same word in German. And the underwriters, they have certain limits, and they can underwrite insurance contract to a certain limit, and after that they have to confer with their superiors, and they have to discuss this in working groups and with other colleagues, and they need the signatures of some superiors. Same in banking. If you were to go to a bank and would ask for a $5 million loan or €5 million loan, I would assume that the loan officer is not able to do so, and even if he were able, he would need his superiors or other colleagues to sign off on this loan because it's way above his limit. And the limits didn't work, for example, for Nick Leeson. He didn't have any limits because he was so successful in trading. They loosened the limits up to the point at which he was able to bankrupt the whole company. Okay. Fourth step is risk control. You need to review the identified risk. You need to review and assess your risk management. Was risk management accurate? How can you do that? in hindsight, it's quite easy. If you know, for example, you invested 100 euros in the S&P, $100 in the S&P 500 1 year ago, and you thought you were exposed to a maximum risk of, say, $20, you can simply look at the S&P 500 today, and you will see that it has increased, in fact, let's say to 140. So your risk management worked, at least for this singular event. Then you take, for example, 100 stocks, several investment classes, and you compare the actual profits and losses with your predictions. And if you see that you were never able to fully correctly predict your profits and losses, your risk management and measurement were not up to speed. So you need to reevaluate your methods. This is back testing. This is actual back testing. You simply take data from the past and you try to assess the validity of your estimates in hindsight. And then you can see, okay, your models were able to forecast risk adequately or not adequately. And then in case it was not adequate, you have to change the models. Okay. And to improve on them. And last but not least, you have to communicate all the information to the managing board, supervisory board, to the supervisor and regulator, sometimes to auditors, actuaries, investors, etc. Okay. This is the risk management process. And it goes on and on and on. Okay. Now, I still have 4 minutes left. I will talk about this in more detail in the next lecture, but I just want to point out one thing. Risk management has a very, very practical side of it. And during most of the class, we'll talk about this practical side. How to measure risk, what hedging opportunities do we have, how can we deal with certain risk, what does the regulator and the supervisor demand of a financial institution, how is it done in banking, how is it done in insurance companies. And it's actually one of the parts of finance that is very practical and where the stuff you learn at universities can directly be used and implemented in industry practice. I mean, there are some topics in finance that are quite theoretical and things you will never see in an actual company in real life, but financial risk management is highly applied because it's also highly quantitative if you want to do it in a more quantitative way. But it also has a research side attached to it, and it's also a theoretical question because still, in a perfect setting of a perfect capital market, with no taxes, no market frictions, with rational market participants, and no transaction costs, why should you do risk management? And in the next week we'll see it's the same result as in corporate finance with capital structure theory. It's the same result as the Modigliani-Miller theorem. Risk management, just as capital structure, is irrelevant in such a perfect capital market setting. Why? You as an investor have several opportunities. You can, if you want a certain risk-return profile, you can invest in a company that does no risk management or in a company that does risk management. But every investor will simply pick the right amount of investment in company A and company B. And if you have no transaction costs, for you as an investor, this is completely irrelevant. If, for example, you have a company with, say, 60% risk exposure, or if you were just to put 60% in the company with 100% risk exposure and 40% in the company with zero risk exposure, with high risk management. So just like in capital structure theory, risk management should not matter. But then why do firms in practice engage in risk management? There seems to be a reason why it makes sense for companies. And the idea is, of course, markets are not perfect. You have frictions, taxes, transaction costs. managerial attributes, risk aversion of managers, risk aversion of investors, and this all leads to the result that firms do engage in risk management, and research is then concerned about the question, what is successful risk management? In research, risk management is usually just derivatives usage. So if a company starts to use financial derivatives in research, this is seen as engaging in risk management, because back 10, 20 years ago, this was all companies did. They didn't have an elaborate risk management. They didn't care about operational risk. They just, if they wanted to do risk management, they just bought derivatives. And there are numerous studies around that look at the question, what works and what does not work. And in the end, it's always an analysis of the effect of risk management on shareholder value. And you can see that risk management does a fine job in increasing shareholder value, but it depends on the methods used. And in some cases, derivatives are also used for speculation, and this makes it hard to establish causality here quite clearly. So it's also a research question. That's what I wanted to point out. And this is quite fascinating because there are some industries where you would never expect such an elaborate risk management. And this is my closing statement for today. If you are interested in one of the first papers on risk management from a financial economics background, you have to go to the JF paper, one of the JF papers in the Journal of Finance by Peter Tufano, who is now, I think, the Dean of the Said Business School at Oxford University. He studied question, what would you imagine? He looked for an industry that only used financial derivatives and risk management for risk reduction, but not for speculation. With banks, it's quite clear. Banks use derivatives for both speculation and for risk management. But he chose an industry that only uses financial derivatives to hedge risk.
Agriculture, maybe?
Agriculture, good guess, but it wasn't agriculture. Because back then, those derivatives weren't around. Back then, the derivatives markets were not as developed as they are today. The gold mining industry. Gold mines dig up gold, and they hedge the risk of gold prices going down, because then they would sell gold at a lower price. And they have always, back for 20, 30, 40 years maybe, they have used financial derivatives to hedge against this risk in commodity prices. I think that's in the mid-90s, this paper by Peter Tufano. Okay. So we'll continue here next week. Do you have any questions? If you don't have any questions, thank you for your attention and see you next week.